started out, I'm 52 years old. I started out really full-time trading in 2009. While I was still working, I was in the private equity industry doing leverage buyouts and M&A up in New York City. And really did that for, God, since 1987 when I got out of grad school. I went to grad school at Georgia Tech and undergrad at Miami University up in Oxford, Ohio. And I currently live in Miami, Florida. So I got a long journey. I've always was interested in the stock market ever since I was a little kid. I can recall fondly that I would wake up in the morning, particularly on the weekends, and grab the business section in the sports page, and the first thing I would do is I would start tracking stocks, and I actually would write down stocks that I was interested in, tickers, and keep track of the prices every week of what they were doing. This was when I was a little kid. For some reason, I just had a fascination with numbers and stats and stuff, and I used to do the same thing with baseball cards and stuff like that. So the stock market always interested me. I was always investing on the side. When I was in school, when I got out of school, though, I started, really didn't start trading that much. In the beginning, I did the first few years, but then I got so busy with my career in private equity that I really didn't have a lot of time to focus on investing. Then I got tired of, when I was investing, I got tired of losing money. And so in 2009 is when I made the first step to get educated. Up until that time, I was basically self-taught in terms of my trading, and was kind of doing things haphazardly and having those type of results. But what I did was started taking classes and learned all I could and spent a lot of time just focusing on learning as much as I could. And so that was back in 2009. That's when I met Jared. And I learned a lot from Jared and the other guys over at the old place, along with other mentors, as I mentioned. But going from someone's, oh, that's mine. Sorry, I got an alert. Going from learning everything I thought I knew. I thought I was going to crush the markets once I learned everything from all the classes that I took, and I quickly found out that you can know a lot about trading, but at the end of the day, it really doesn't guarantee any success in the markets. And so I went through some trials and tribulations, probably like a lot of people, in trying to find the holy grail of trading, that it had to be some indicator or something, some setup in the chart that I was doing wrong. And I realized after a lot of time spent that there's really no holy grail out there. And if you go searching for it, and if you try to find order to the market, you'll be lost forever, because really the only order that we can bring to the market is our trading plan. And it took me a long time to find that out, because I was so used to having success in my career and being able to work really hard and to knock down walls with hard work and knowledge. And in the market really doesn't care how much time you put in. It doesn't really care where you came from, what you know, how much money you have. At the end of the day, in the stock market, I learned that we're all dealt the same hand. And why do some people make money when they're dealt the same cards and other people lose money? And I quickly found out, I didn't quickly find out, I eventually found out that it's really in our head, and it's really our trade management and risk management that really eventually determines whether or not you're going to be successful. So I started spending a lot of time kind of really analyzing that aspect of trading, and while also mastering other things like entries and exits and stuff. But just in terms of being able to realize that if I want to have success and I want to do this for a career, then I need to be able to manage my emotions and manage myself more than manage my setups and entries. And so I really focused on that part of my trading, and it really turned my trading around is really my risk management and being able to take stops when I'm supposed to take stops and exit when I'm supposed to exit. I mean, I think there's really kind of three phases that traders go through. One is, I think we all go through, is really being a losing trader in the beginning because we don't really know what we're doing. We don't know that the market is going to do whatever it wants to do, and we have no control over that. And that aspect of trading can be frustrating. The second part, I think, is that you learn how to control your losses, and that's the part I was mentioning. Is once you get to that evolution of trading, I think once you're able to control your losses, you finally have a fighting chance to survive in this business because this business is very ruthless. And if you don't have good risk management, it doesn't matter what type of batting average you have, you're going to get crushed one day and you're going to blow out your account over a series of trades or weeks, months. It's just a matter of time, no matter how much money you make in the beginning. So once you learn how to control your losses, if I was a new trader coming in and I could give advice, it's really just you need to focus on the setups and stuff like that, but at the end of the day, that's not really the most important thing. For a new trader particularly, it's really, do you have the ability to manage your risk? Can you trust yourself to take the stops when you're supposed to take your stops? And if you can do that, then you can really start focusing on refining your entries and managing your winning trades once you have winning trades. And then I think the third evolution is really becoming a trader is really learning how to manage your winners. And so once you have your risk management under control, then you can really focus and you can adhere to your trading plan regarding your risk management. Then you can really focus on how am I going to manage my winners and what's, like Jared mentions a lot in Omno MJ, is it really needs to be tailored to your own psychology because every trader is different. Some traders can hold forever and go through drawdowns, and that doesn't bother them because they have a history of doing that system and they know over time it makes money. Other traders are going to be more quick to the trigger, and so there's no right or wrong. It's a matter of what fits your psychology in terms of managing your winners. But there's one thing that that holds true for all traders, and that's you got to be able to manage your risk. I manage a small hedge fund. When I left my job in about 2 years ago, I started a small hedge fund with my money and friends and family money. So I've been doing that for 2 years down here in Miami. My wife and I moved from New York to Miami, and I've been doing that full time. I have an office in downtown Miami, which is where I spend basically my life, according to my wife. And so that's pretty much my background. So again, to reiterate, there's really kind of three things that I think the evolution of a trader is. One is you're going to be a loser initially. You're either going to think you know it all and you're overconfident, and the market's going to teach you some harsh lessons, or you're not going to know what you're doing. I think it's imperative for new traders to get as much education as possible and really focus on knowing yourself. And if you don't know yourself well, trading will teach you, because all the demons that you have inside yourself that you never knew you had will come out in trading. And they did for me in terms of my risk management. And that was my biggest bugaboo, because I was way overconfident when I started trading, because I took all these classes. I thought I knew everything. And if a position went against me, I thought I was so good that I could manage out of the position. And a lot of times I did, but there would be that one trade that would come back, that wouldn't come back, and you would get crushed for a week or 2 weeks of profit. And so I learned that at the end of the day, really, you got to focus on your risk management. So once you have that under control, the third step would really be learning how to manage your winners. And I think if you want to be a big trader one day, both intraday and swing trading, you can't be a P&L trader because P&L traders never become big traders, and that's both intraday and swing trading. And so you got to somehow. In some traders, it's not an issue. Like for me, I'm really good with being patient with my winning trades. And I was too patient with my losing trades in the beginning, and now I'm just the opposite. I'm very quick with the trigger on my losing trades, but once I have a winner, I'm willing to add to that trade, and I'm willing to sit patiently through it. I'm also taking profits up along the way, but I'm moving up my stop and allowing it enough room so that I can have a big trade. And the P&L really doesn't affect me on the trades it used to, but it doesn't really bother me. I guess it's probably a little easier when you're managing a portfolio of positions too, because you have winners and losers, and so it kind of balances things out. Whereas if you're managing one trade, it can be a little different if you're watching your P&L and trying to manage your trade by looking at your P&L. So that's pretty much it. Let me see what else I wrote down here that I can tell you guys. Oh, another big thing is you guys got to have a routine. I don't know what all your routines are, but if you really want to be successful, you really make your money after the market closes. And what I mean by that is, particularly for swing trading, is you got to have a routine where you're going through your watch list every night. You have to have some sort of a scanner or a charting program, obviously, that lets you go through your watch list, and you got to be prepared when you come in the morning. I usually get into the office around 6:30 or 7 in the morning, and so I spend the first 3 hours, 2.5 hours every morning going through my charts, maybe reviewing some educational stuff in terms of other things that I'm interested in or learning. And then after the market closes, I'm obviously logging all my trades in on the trades that I took on both my swing trades and my intraday trades. And I spend a lot of time really just analyzing my my losing trades, because I'm really focused on what is the reason why I'm losing on my losing trades. So I'll look at my last 10 or 20 losing trades and see if there's any common theme to my losing trades. I don't mind getting stopped out. What I don't want to do is have losses bigger than what I should be having, because I know if I keep my losses under control, I can make money in the market. So for me, at the end of the day, it's just about managing my losing trades, and at the end, and that means managing myself rather than the market, because we can't control the market, and the market's going to do what it's going to do, right? It does crazy things, and I guarantee you that the market will do things that you don't expect, and you can count on it that it will do that, and it will do it at the time that you least expect it. If you look at the Lulu chart from yesterday, you can see Lulu, they gapped it up, or there was some news intraday, and the stock went up to, like, I don't know, $68 or $69. It was up $3 or $4 on a spike, and it stayed up there. And I have a news service called Briefing, and there was chatter about a potential takeover of Lulu, and that somebody floated that out there, and you can see the stock spiked up, and there was institutional selling into that spike. And the reason why is this morning I came in, and there's a downgrade with a $52 price target on Lulu from Goldman Sachs this morning. So obviously that news that Lulu was a possible takeover target that floated out there yesterday was intentionally set out to manipulate that particular stock, so that some institution before Goldman, they knew Goldman was issuing a report. Some hedge fund that Goldman was their prime broker, gave them a heads up that that report was coming up, and so they floated something out to create volume so that they could sell into. So these are the types of games that are played in the market, and at the end of the day, all we can do is follow our trading plan and adhere to that. If you don't have a trading plan and you don't adhere to your trading plan, you're not going to be around long in this business, because this business will spit and chew you out quick. And people that trade on emotion and don't have a plan will not last. So that's something you definitely got to have. The other thing is particularly for newer traders, you got to keep, if you're day and swing trading, my advice is not only focusing first on your risk management, but keeping your watch list extremely small, particularly in the morning when the market is going crazy. So if you focus on maybe 3 or 5 stocks that you're gapping up, or stocks that are in play from the prior day that have institutional buying, then I think you'll do a lot better than if you have maybe 15 or 20 stocks on your watch list and you're scattered all over the place in the morning and you are not focused. So one of the things that you can do is every day, at the end of the day, take those 5 stocks that you're watching and just go back and look at the chart and see how many setups were there and how much money could have been made in each one of those charts. And you'll see that if you have just 5 stocks up, that it's more than enough usually for you to make money in the morning if you're intraday trading. So I think a lot of problems, one of my issues too was in the beginning was my brain was focused everywhere. So even though I have a lot of scanners and stuff, I really just focus, particularly in the morning, just on probably one screen of thumbnail charts, and I'm completely focused because I know there's going to be money in one of those charts, and if I take my eye off it, I'm going to miss it. And that happens when you're scanning and doing other things that you shouldn't be doing. So focus on a small watch list in the beginning until you can consistently make money and manage your risk. And if you're a new trader also, I would just focus on trading one position at a time in the morning, because the market's too crazy to be focusing on any more than one position for most people, particularly newer traders. Let me ask everyone a question in the room. If you can type in how many years you guys have experience trading. All right, that's pretty good. I think a rule. It took me a while to get consistently profitable in trading, because I think in the beginning I was way too overconfident, and I wasn't a good manager of my risk at that point in time, because I always thought I could trade around the position and get out of it. So you've got to, no matter how long you've been trading, again, risk management is key. And I think that's pretty much it. I think what we can do going forward is I talked to Jay, Amnal, and Jared about me coming on. There's a lot of subjects that I got a lot of experience in from trading. I trade, to give you a little background, I trade equities and derivatives, both long, short, and my fund. It's probably 80%. I carry anywhere from 20 to 30 positions in my portfolio at the peak at one time, and most of them are through, let's say at least 60-70% is through derivatives, which is basically options. I use a lot of option strategies, both directionally and volatility-based strategies, which are more income-based strategies that I put on mainly on indices in certain particular stocks. But one of my goals was always to become a well-rounded trader, not only intraday trading, but also being able to manage a portfolio, knowing how to hedge a portfolio. If I have exposure in the market and I want to hedge my positions, but I want to remain long, how do I go about hedging that? How do I go about hedging those positions, either through the market or in terms of the the indices or the futures or derivatives. A lot of my positions that I go long or short in, I'm actually creating synthetic long or short positions with a hedged position with a put or a call, depending whether I'm long or short. It allows me to manage my risk and lets me sleep at night. So if I have a portfolio, I have no problem taking 50% of a position. That's my total portfolio in one position overnight because I'm hedged in the position in terms of being directionally long, but I have a stop that's, if I'm long, I'll have a stop that's a put that if the stock gaps down to 0 tomorrow morning, I know what my total risk is in the trade. So it's a structured trade, whereas most people, when they swing trade, they just buy the stock and then they put a stop in. They soon realize that if you buy a stock at $100, it can gap down to $50 in the morning. And it doesn't matter where the hell your stop is. But when when you're able to use options, you're able to create a structured trade because your risk is defined up front. So I know exactly what I'm risking in a trade. And when you know what you're risking in a trade and you're not relying on the market to take you out of a stock, you don't care what the stock does. Well, you want to make money, but you know at the end of the day that this is the most I can lose in the trade. You can sleep well at night, and you can do well because if you're risking, if you have a set defined risk and your upside is unlimited, and you have a structured trade, you don't even have to worry about your risk management because on the worst case scenario, uh, your trade goes to your maximum risk, which is something that you defined up front when you put the trade on, which is something that you don't even have to do. I'm just saying that if your max risk is X, then you know at the end of the day, when you go to sleep at night, wake up in the morning, if it's at X, you can't lose anything more than that. And usually I'm not even hitting my max risk in trades. If it goes against me, I'm taking it off well before it hits my max loss. But I know what my max loss is, and I don't have to worry about what the market does because it locks in my max risk. So those are some of the things that I do. I probably spend about 80% of my time now on my swing trades and about the rest of the time trading intraday, particularly in the morning and afternoon. And I found out that if you do have a portfolio, the way to really make money in this market is to swing trade. You can make a lot more money swing trading than you can day trading. And what you have to learn if you're interested in swing trading is that you have to learn and become a well-rounded trader and learn how to trade options, because if you're trading overnight swing trading and you're not using options, you're not using everything to your advantage. Options are a huge advantage in swing trading, again, because it lets you define your risk up front and it has unlimited upside. And you can do really well with that type of concept if you have a portfolio that allows you to do that. You don't have to have a big portfolio to do options to swing trade, because yesterday I went long Zillow, and Zillow's trading at 113. If I wanted to buy 1,000 shares, that was $113,000. And what I did with Zillow is I bought a call and I bought a put, or I bought a call and I sold a put with the same strike, which is the same thing as going long the stock. And I did 10 contracts, which is basically equivalent to 1,000 shares. And I actually got a credit for the trade, which means I got paid to put that trade on. And then I bought a put, one strike below it at 114, and I paid like $3 and something for it. So I bought 10 of those, so I paid $3,000 minus the credit that I put on, or that I bought for the synthetic long position. So my total position cost was like $2,500 in a position that controls $113,000 of stock, and my max risk is like $3,000 in the trade. So those are the type of things I do on my swing trades mostly. So I appreciate you guys letting me come on. Why don't we open up, see if anybody has any questions? I'd be happy to stick around and answer them, and maybe we can do this, on a more frequent basis. Do I always let the market? Hey, Neil, how you doing? Neil and I used to email each other back and forth back in the day. No, I always, I'm always, when I enter a position, I'm always scaling out when I get into profits, and so I'm always taking up profits along the way, both of my swing trades and intraday trades. But I always like to leave a piece in, both on the intraday trades and on my swing trades, to make the market take me out. And that, in other words, there's a lot of ways you can allow the market to take you out. You have to find something that's unique or something that's fits your personality. You can bar by bar trail. You can let a moving average like the 80 EMA take you out. You can use a pivot trail stop in a smaller time frame. So a lot of times on my intraday trades, I'll trail out on a 1 minute pivot, and that's where I'll put my trailing stop. I'll trail it up on a 1 minute pivot. And then I'll sell into the excitement. So when you see price get separated from the moving average, you go back and look at your charts and put an 8 and a 20 period moving average on your chart, and then watch when price gets separated more than normal from that particular moving average, whether it's obeying the 8 EMA, if it's really a stock in play, or it's obeying the 20 EMA. When the stock gets extended from one of those EMAs, that's when you want to start selling and scaling out of your position into the excitement and the emotion, and then I will trail, another portion of it once I scale out, and I'll always leave a piece, both on my swing and day trades. So the other thing that I mentioned is, like, when I do my swing trades, I'm doing a synthetic long call with a put that hedges my position. So I was long Zillow at 115, and I bought the 114 put. And so if the stock moves up $10 from 115 to 125, I have that 114 put, which I lost money on, but I made a lot of more money on the long position. And what I'll do is I'll move that 114 put up to, if the stock moves from 115 to 125, I'll move my 114 put up and roll it up to a higher strike that allows me to lock in my profit on my swing trade, but allows me to participate further upside in the market or that particular stock. But I have guaranteed profit in the trade by selling the lower put and moving it up to a higher strike put and locking in my profit. So these are kind of little nuances. And once I learned this stuff, I learned a lot of this from other mentors, and some of it I figured out on my own. And how do professional traders, and that's not something that we're usually taught in school and stuff, is how do you invest, how do you trade? And there's a way to invest that unfortunately is not taught in our school system, and using options is really the way to go, or at least if you're going to buy stock, buying insurance, a put, to hedge your position as a stop. Instead of having a physical stop or a mental stop, you buy a put, and then as the stock moves up, you roll your put up and you lock in your profit. So that's pretty much all I've got. Did anyone else have any questions? Let me read these. Hold on. Michael, what books, resources were the most useful to you? Wow. I have a whole library of books. I'm kind of a geek in terms of trading. And so I have like a real thirst for knowledge in trading. And at the end of the day, most of the books are bullshit. And it's not going to help you make money. But I like to collect books because this is like my passion. And so I collect trading books. Particularly like the classics from way back when. And some of my best things that I learned were from Wyckoff. And Wyckoff was like a stock reporter. He created Barron's Magazine at that time, like in the 1920s. It became Barron's Magazine, but at the time it was called something different. And he studied he was friends with some of the great traders at the time in the 1920s, including J.P. Morgan and Jesse Livermore. And so he wrote a lot of books on how these guys traded, particularly Jesse Livermore. And it was, if you've never heard of Wyckoff, I really suggest that you guys learn all you can about Wyckoff because it'll really help your trading. Really understanding the market and why the market moves the way it does. When I started learning Wyckoff after I took all the classes at Pristine and stuff, it really opened up my eyes to a lot of things. And these principles go back to the 1900s, and the market still moves the same way it did back then. Maybe a little faster nowadays with the computers and stuff, but in terms of the fear and greed, the way prices move, it's the exact same way. When you look at a chart from the 1920s, it's the same dang chart today. So basically, Wyckoff teaches you price action, and he teaches you how really kind of the three laws of the market, which is the first law is supply and demand, how that works. The second law is cause and effect. And the third law of the stock market is effort versus result. So supply demand, people understand that. Stocks move based on supply and demand, and that's what moves stocks. And it's not the stocks that we trade, but we're actually trading people at the end of the day because it's people that are on the other end of the trades. Two is cause and effect. Basically, that law explains that the consolidation pattern needs to occur in order to have a move. And so you'll see an accumulation or a distribution pattern before, or you'll see an accumulation pattern before a stock can move because it's large interests that control the stock market, and they can't accumulate a lot of stock unless the stock is stationary or declining if they're trying to get long for a period of time. So they keep the prices down until they accumulate enough stock, and so you learn to recognize patterns based on Wyckoff that where accumulation is taking place. And then the third law that I mentioned was effort versus result, and this is probably one of the key things. People don't understand volume. Volume is extremely important in the market. Volume is everything other than obviously price. Price is king, but I'm telling you, volume is huge in the stock market, and volume gives you clues well before price. And that's why a lot of people who trade candles, they get tricked because, oh, it's a big green candle, it's up. But what is the range of the candle and what is the volume? So effort versus result basically is a form of tape reading that allows you to determine ease of movement in a candle relative to the volume. So if you have, and it's all in context to the trend. So if you have a large move in a candle on a lot of volume at the end of the move, often it's climactic, and the opposite if you have large volume on a move with a small range candle. Why is that? There's a lot of effort in terms of volume to move that candle, but the candle didn't go anywhere. So somebody was either buying or selling into it depending on the context of whether the candle was coming down in a downtrend or the candle was going up in an uptrend. So these are all things that I learned from Wyckoff in terms of just the macro picture of learning. And again, these principles were around in 1900, and it's basically tape reading. And I can show you a chart. I do use a couple indicators, and one is a kind of a tape reading indicator that really, instead of measuring volume on a bar-by-bar basis, I measure volume based on the waves. So from pivot to pivot, I look at this indicator tells me how much volume was traded in the pivot, and it's much from one pivot point to the next pivot point. So if I'm on a 5-minute chart and prices go up from $10 to $10.50 and then retrace, it tells me how much volume was traded in that retracement. And it's much clearer in terms of looking at how much effort or volume was in that retracement. than looking at individual candle volume, and so you get really good picture of what's of what I call tape reading, because you can see the volume on up and down moves, and you can see the length of the up and down moves. So if you have a small down move on a retracement with very little volume, that's probably bullish in the context of an uptrend. But if you have, it can also be bullish too if you have small downtrend but huge volume, but the stock only retraces slightly, then that's also bullish because the stock tried to retrace and all this volume came in, and it only could retrace maybe 25% of the original move. Well, why is that? With all that volume, it should have came all the way back. No, because people were sitting there buying it. So volume's a tricky subject, and most people, 99% of traders, don't understand volume. And if you want to really improve your trading, one, risk management, two, learn all you can about volume and how that is kind of red in candles on the chart. So, there's three. Let's see, one. There's three guys that I learned from Wyckoff. Unbelievable teachers. These guys, they're old school. They've been around forever. But some of the best traders I know are guys that are like 60, 70 years old that have been doing this forever. I mean, these guys can pick a chart and trade like no one else. And so one guy that I learned a lot from was Jeff Cooper. He's probably like 68 years old, and he made all his money trading. He lives out in Malibu, California. And you can Google his books. They're still around, but he probably wrote them in the 90s. And actually, he still has a service. He has a stock picking service. He's really good. So I learned a lot from him. But in terms of Wyckoff, there's three guys that really are that you can learn from. And the biggest Wyckoff expert out there is David Weiss. He's like 80 years old. He lives in Boston, and he's been doing it for 50 years. And it actually just came out with a book last year that's on Amazon, and it's can't remember the name, but if you Google, I'll type it in. David Weiss, and he has the name of the book here, Trades About to Happen. So I learned a lot from him, and then there's actually a Wyckoff Institute. I never took the class there, but they have some class. I wouldn't get it. I would just, you can Google it. I think the course is on, you can probably get it for free on the internet. There's copies of it floating around, but I wouldn't spend a lot of time going through that because it's kind of antiquated. Not in terms of the concepts and stuff, but the material's hard to read and stuff. The other guy is Gary Follett. He actually has a I think it's with two T's, I'm not sure. He's in Chicago. He used to be a floor trader. Most of the floor traders use Wyckoff. If you tell, oh, Wyckoff, all the floor traders back in the day, they'll tell you Wyckoff was the man. That's how they learned to trade. And it used to be a big secret, like, oh, how do you trade the market? And they go, hush, hush, we know this concept, Wyckoff. And it used to be a big secret. And a lot of the big hedge funds back then used to use these principles to trade, and they used to kind of try to keep it a secret from the public back in the day. This is like in the 50s and 60s. And so Gary, he actually has a free webinar every Sunday night that he teaches Wyckoff, and you'll learn a lot from Gary. I've never seen anybody be able to read a chart as well as Gary. Not that that makes you a great trader, but these are all kind of skills you need to have to be a trader, just to even, get in the plane and fly your plane. So if you don't have the skill set, which comes through education and learning to trade, then you're putting yourself behind the 8 ball. Then, as I mentioned earlier, even if you have all this skill set and knowledge about trading, it doesn't guarantee your success in trading, because at the end of the day, you have to be able to manage yourself and control yourself, because the market's crazy. It's going to do what it's going to do, and you can't control the market no matter how big you are. And the only thing you can control is yourself at the end of the day. So you got to take your stops when you can, and you got to learn a trade management on once you're in profit of how to manage your winners that fits something that you can do personally. And then the third person, so David Weiss, Gary Follett, and Gary Dayton. He's really good too. All three of these guys are like A+ in terms of learning how to read the tape. And that means basically looking at a chart and bar by bar analysis based on price action, the spread of the bar, and the volume. And Gary actually teaches a class every Wednesday that I'm in. I've been doing that for 4 or 5 years. I'm in his class every Wednesday. I'm in Gary's class every Sunday night. And I learned a tremendous amount from all those guys, along with the concepts that you learn from Jay and Amnal and Jared here. So that was really my foundation when I started training, was pristine. I took all the classes, every class, and it was really the ABCs of my trading. It gave me the building blocks to what I became today. And then what I did is I just didn't take it at face value. It's like there's other stuff out there, and I explored everyone in the room to find out what works for them, because there's no one thing that works for everybody. If you look at these, what's the book called, where the guy interviews Schwager, that interviews all the great traders. The one thing, if you read that book, yeah, Market Wizards, thanks. If you read Market Wizards, man, it's like every guy in there trades differently, right? They trade different instruments. Their strategies are different. Everything's different, but at the end of the day, there's one thing, like a conclusion that's drawn. Why are these guys, killing it, or why are these guys successful? Were they able to make a career of this? And that's because of risk management. At the end of the day, that's like so important. I can't tell you guys that enough. Is just like focus on that first. Don't focus on your setups, your entries. When you're a new trader, that's all you're focused on. That's all I was focused on, the chart. Is, man, you got to be able to trust yourself first and follow your rules in terms of your trade management. Because if you do that, then you have a fighting chance to make money in this game. Without doing that, it doesn't matter how good of a chart reader you are. How much you know about trading, you're throwing that all away. All that you studied, all of that you learned is no good, because if you can't manage yourself and your risk, then it's just like, forget about it. You're not going to make it. And it's like a shame, because you spend all this time learning all this. I spent more time learning than I could have became a medical doctor. But I was, in the beginning, pissing it all away because I wasn't a good risk manager, and I was too overconfident, because I thought, oh, all you need to do is know all this knowledge about the market and stocks, and move out of my way. I'll show you how it's done, and this is that. And it's like the market will quickly humble you if you don't manage your risk, because you're going to be wrong a lot in the market, and it's not about whether you're wrong or right on a stock. And that was hard for me in the beginning. It's about making money. And you have to understand that you're going to have bad trades, which I call mistimed trades, because a lot of times the trades eventually do work out. But if you don't take your stop, you might not be around to see it work out and be able to get in, because you can always re-enter trades. And but you got to get out when you're supposed to get out, so that you can live to fight another day. And if you manage your risk well, you're going to have trades that are big winners, that are going to more than make up for any losing trades, as long as you're managing your risk. And so that was the turning point, really, for me, in terms of really being able to turn my self into a consistent trader, and being able to walk away from a job 2-3 years ago and do this full time. And this is all I do. This is my only source of income. And this is something that I always wanted to do, because I love it. I have a real passion for it. And that's the other thing, is if you don't have a passion for trading, it's going to eat you up. because the market is really hard. It's particularly when you're learning it in the first few years, the market's going to try and break you. And if you don't have a passion for it and a love for the stock market, you will not survive. There's just, I don't care how much you know or how good of risk manager you are. If you don't have a passion for it and love what you do, you're not going to make it in this game, because the market, you're going to have those days like, what the hell? You just get crushed and you like did everything right and you're just like, wow. So, and you're like, you go home and you're like, you want to pull a bag over your head and just run into the closet and just sit there and like cuss yourself out and stuff. And so if you don't have it, what allows you to come back from that is just having a willpower and a passion to get through those tough challenges when you're starting out, to get through those bad periods. And eventually it gets better. I mean, I remember, it's like, oh, I can't do this, when I was starting out, the first couple of years, it's like, this is crazy, it's like, I would come home and I'd have a terrible day and it's like, I'm done, it's like, I can't do this anymore. And then, a half hour later, I'd just be lying in my bed thinking about it. It was like, screw that, I can do this. And it's like, I can't imagine doing anything else. And so that's what kind of drove me. And always had a big passion and drive to be the best I could. And so that kept me going through the tough times. And eventually I learned, shit, I know so much and I know how to trade. It's just a matter of managing the risk at the end of the day. And so anyway, that's kind of my story and things that I recommend for people. But let me read some of these comments. I haven't been paying attention. I've been watching my positions. Sorry. No, they don't teach the option strategies. Basically, the best way to learn about option strategies is first read a good option book so that you're familiar with the concepts of options and stuff. And then I know Amnal teaches a class, so I would definitely take that. And if you have a portfolio, eventually, if you want to be a well-rounded trader, you have to learn not only and you want to make a career of this and you want to use this as your only source of income, you've got to learn how to trade options, and not only intraday but swing trading. And you need to learn how to trade options not only directionally but also non-directionally. And by that I mean learning how to set up positions in the options market so that you're capturing income through theta decay and volatility. So if theta decay and volatility are strategies that allow you to make money in the options market without having to pick a direction in the market, and you make that money over a period of time as the options expire. And so those are all things that, particularly on the income side, I do now, and something that I really poured myself into over the last 3 years. So when I started doing this full time 3 years ago, I was just a directional trader, trading long, short, intraday and swing. And I was like, dang, the market, it can do crazy things during the course of a month, a day, a week. And you're not always perfect in terms of timing the market, but I needed a source of income that could smooth out those bumps in your P&L and allow me to put on big positions that would generate income on a monthly basis. And so over the last 2 or 3 years, I really spent a lot of time learning about how to trade non-directionally in the market. And talk to a lot of the pros, a lot of the things that they do is they trade non-directionally. So they can be right if the market goes up, they can be right if the market stays where it's at, and they can be right if the market goes down a little. They still make money. And so learning how to put those types of positions on an overnight position that you can do for a month and do it consistently over and over every month is a magnificent way to learn how to trade. And then you combine that with your directional trading abilities that we learn, from Jared and everybody at Live Traders. It's really complements your trading. So Anyway, I'm rambling on, but that's really kind of what I focus on within my fund. Directional trading and non-directional trading in both intraday and swing trading. So hold on, let me read the rest of these comments. What kind of organizational strategies do you use to keep track of all of your ideas and trades? I have this big, huge, I have a summary of my trading plan, but then I have this big thing, like when I read books or learn something from somebody else, I type it into this big journal that I have. And so then at the end of each week, on the weekends, I go through my journal and then I look at, is that something I'm going to incorporate into my trading, or I want to learn more, and then I will put it into my trading plan. And as I learn about that particular thing, for example, learning how to trade directionally in terms of using some sophisticated strategies of options over the last 2 years is what I've been really kind of focused on. So like the Zillow trade I put on, where I'm learning how to put on a synthetic long or short position with very minimal, hardly any capital requirements, and then being able to hedge that position with a put, but still leaving upside. Those types of trades. What options books do I recommend? Any basic options book. I don't know the names of any right here. I don't have any in front, but I would just go through Amazon. There's a lot of good books. You don't need any like 2,000-page book on options. You just need to learn some of the Greeks and the basic strategies. Just so, not that you're going to use them, but so you have a principle, an understanding of options, and then when you take Omnol and Jay's class, it'll give you the background so you'll understand everything better while you're doing things. Yeah, Tasty Trade, I see Tasty Trade all the time. So those guys are a little biased because the one thing I have against Tasty Trades is they only believe in non-directional trading, basically. So they don't believe there's an edge in the market other than knowing where the standard deviations of a move are and stuff. So anyway, Tasty Trades is good. They teach you a lot, but Tom Sasanoff, the guy who founded TOS, doesn't believe in having an edge in the market other than what the option market is telling you. So he doesn't think you can look at a chart and have an edge. But you can, especially if you learn Wyckoff and you learn everything that live traders are teaching you about how to read candles and stuff. If you learn Wyckoff, you can really learn how to read a chart, and you can look at a chart real quick and like, okay. That's what they're doing. It's like if you look at the chart for Baba, look at the chart for Baba. If you look at the day, when was it? Let me pull it up. This was one of my big trades, and it was on the day it broke that support. It was Tuesday. Tuesday. Look at the bar that was formed Tuesday on the daily chart for Baba. It was, look at all that volume that came in that day. It broke support, right? It scared everybody. And everybody got out of the stock that owned it from above, right? They were all losers. It broke the low from its all-time low. And look at where that bar closed. It closed mid-range on Tuesday on all that volume. Well, with all that volume, the bar should have been a big red solid bar with all that volume coming in. If you look at other bars on that chart, with that volume, you would have had a much bigger bar. So that told me all the smart money was down there buying that stock on that day when everyone was getting scared out of their positions. And sure enough, there was like news on CNBC that night, oh, Baba's done. I was getting emails from people just out of the blue, those marketing, oh, time to short Baba, time to get short. And basically, when the market, right before the market closed, I bought a couple thousand shares. I think it was like 3,000 shares of Baba. on that Tuesday. And then the next morning, this is a key too. The next morning, the stock pre-market was trading down $1 from where it closed the night before on Tuesday. But on light volume, I don't know, it's maybe like 10,000 shares had traded or 5,000 shares. And I'm like, I came in, it's like, okay, it's down $1.10. I'm going to have a headache today because I'm going to have to deal with this position. And then when the market opened, it took off right from right from the get-go. And I see this all the time. They manipulate it, particularly when there's no news on the stock. What they'll do is in the pre-market, they'll take the stock down, the market makers, because they'll know what orders are coming in. The market maker that manages BABA, he already knows before the market opens, institution XYZ wants to buy 2 million shares of BABA that day. Goldman Sachs wants to buy this many shares of BABA that day. The hedge fund wants to buy 2 million shares of BABA that day. So what he'll do is he'll take the stock down pre-market. So it was down $1.10 pre-market, making the stock look weak. So that scares everybody even more so than the day, just like they did the day before, knowing that they have all these people institutions who want to buy. And so sure enough, when the market opened, the stock never looked back, and it was the biggest green bar, I think, or close to the biggest green bar that the stock's ever had. And so that's just the games they play. And if you learn Wyckoff and how to read a chart, you can see that. It's basically, Wyckoff calls it bag holding, where they take a stock down, they take it through key support areas, and he calls it a spring also, where then all the smart money is accumulating down there. You'll see a narrow range bar or a bottoming tail bar or something like that, a narrow range bar on high volume. Well, if you had all that volume, why is the range of the bar narrow? Because it was a lot of resistance. That's why the bar couldn't go down as far as it should, because there was some big money just sitting down there saying, give me all the stock that you got because I want it all. So that's what they did with BABA, and you saw what happened. It went up $5 or $4 the next day. So it's just, when you have big money, you have a lot of advantages in the market, but we also have huge advantages in the market because as individual traders, we can get in and out of our positions quickly. We don't have to play games. We don't have to try and deceive people. We can just get in and out because our positions don't move the market. But the institutions, they have to play all these games. They have to make stocks look weak so that people sell into them. And they have to make stocks look strong so that they can sell their position into them. That's why you always see on climactics, you see big wide green bars when it's climactic up, and that's usually the end of the move on high volume because the institutions need that high volume to sell into. And same when the stock is coming down, they need that wide range bar and high volume to accumulate a position so they can get enough shares before they can mark it up. Let me read the rest of these questions. Yeah, on my longer term trades, good question. On fundamentals, yes, I do use fundamentals, but I use a fundamental screen. So usually I'm using Investors Business Daily or some other type of screener like that. And so I have a watch list of strong stocks that have good fundamentals and accelerating earnings growth that I use, and then I keep and that are in a strong uptrend, defined by the 80 EMA is above the 20 EMA, and the 20 EMA is above the 50 EMA, and the price is above the 20 EMA. So those are running kind of parallel, those three moving averages, and then I know the stocks have good fundamentals, and they have strong earnings. They beat earnings estimates. So but usually you see that in the chart because it's going to be reflected in a chart. But so I have a swing watch list of those type of stocks, and so I know that they have good fundamentals, good positions, but that doesn't mean crap if the this stock is overvalued because stocks can get overvalued and undervalued because stocks in the short term don't trade on fundamentals. They trade on fear, greed, and emotion, and stocks can stay overvalued and undervalued for an extremely long period of time. So if you're going to just trade on fundamentals, you got to have deep pockets, and you have to be willing to hold your position for at least a year, because it'll take at least a year sometimes for some catalyst to make the stock realize what you think or what the market should think the fundamentals or what the stock is worth based on a fundamental basis. But eventually all stocks move to their fundamentals. So basically I say that fundamentals tell you basically what a stock is worth, and technicals tell you how you're going to get there. So if a stock is worth X amount and it's trading below that, it's eventually going to get to that point. And there's some reason why the stock is not trading at that point right now, but if you're just going to trade based on that and not the technicals, you can have serious drawdowns until you're proven right. So I always trade all my entries are based on technicals, not fundamentals, but I'm investing, if I'm holding positions overnight, usually in good stocks. I do a lot of like reversal trades and stocks that have bottomed out that are good names and stuff like that, like Ralph Lauren and Tiffany. I have positions in those right now, although they're not doing great. But so yeah, those I do invest in fundamentals, but I don't make my investment decision. I just want to make sure I'm in stocks that are quality stocks, particularly when I'm swing trading. And what I try to do is I really try to look for stocks that are generational stocks. I'm going to swing trade them, so I want explosive stocks that can, double or triple in a short period of time. Okay, Jared. Yeah, thank you guys. I really appreciated you letting me come on, and I hope I made some sense. But again, make sure you have a trading plan. I know everybody tells you that, but you're gonna your success is going to be determined by managing your risk, and at the end of the day, that's the most important thing in trading, managing your risk. I know hedge funds, they get positions, or they get people coming in interviewing for positions, and I know guys that interview traders for hedge funds, and they come in with these great strategies, and the guy goes, I don't give a squat about your strategy. I want to know how you manage your risk. Because at the end of the day, your risk is what's going to determine whether this company stays in business or not your strategy. So always remember that. It's your risk management, not your strategy. You need both. But if you don't have risk management, your strategy is never going to be fruitful. So, all right, guys, I appreciate it. Thanks. I'll be back on in a couple weeks. Okay? Bye-bye.